Welcome back to Nothing But Net Income, where valuations are the end game. I'm your host, Adam, and we are going to talk today about Topgolf Callaway brands. That's ticker MODG. Don't ask me why, but we're going to hop right into it. Brand new channel. We've only got one other video out as of recording today, which it's the 10th of August. I try to keep these videos pretty broad, though, so they're not just applicable right after I record them. This is going to be for long-term valuations. Hopefully you can glean something good out of this analysis. So let's dive right in. What does MODG or Topgolf Callaway own? They own obviously Topgolf and Callaway. Callaway sells golf equipment, apparel. I've got a couple of their items of clothes. Topgolf, they are popping up everywhere, especially in big metro areas in the U.S. and even abroad now. So Topgolf, if you've never been, they really, they've made golf into a huge entertainment type industry. It's more than your average driving range. If you've never been to one of these places, they're really spectacular. Something kind of just you got to see to believe. They have a lot of games that you can play with your friends within your own bay. You can rent out a bay and just kind of see who can hit the longest drive, who can hit the most accurate shots, hitting different targets on the ground. It's a lot of fun. They own a lot of other golf brands. They own the technology behind some of these tracker softwares in Topgolf. They also own different putters and different equipment and household names with different apparel you'll see there, like Jack Wolfskin and others. So they've got a lot of different brands, but we're going to hop right into why I think that actually Topgolf Callaway, especially Topgolf, is really bringing golf back. You can see in this chart here, the green shows the amount that golf has been played on courses, and that's that dark green, and then the light green shows off-course participation only. And you can just see that really people going to places like Topgolf is exploding, even though that actual golf demographic might be shrinking in the past decade or so. They speculate this has to do a lot with just the younger generations don't have the same interest in golf that the older generations do. But you can see there's definitely some form of interest with going to a driving range or just, going to some other golf type experience. And that's really what you see with that green, that light green bar at the top. It's just really skyrocketed over the past few years from almost nothing back in like the mid 2000s to really over 40 million people now participate in golf, with the addition of those who just will go to a driving range or something like Topgolf. So let's talk a little bit about the quarterly results. They just reported a couple days ago as of this recording. And one thing I want to tell you right here, it's good news in terms of revenues and profits are both up year over year. So you're going from 1.15 billion dollars in net revenues to 1.179. So a good jump over the past year. That's a change of up 5.7% over the past year. And you're also seeing that net income come up as well. And net income is so important because that's that money to the bottom line. And it's actually gaining faster than that revenue. That's up 11.4% over the past year. So this is very important. You want to see this. You want to see net income even rising faster than revenues. And you're seeing that with Topgolf, but it should be noted that the second quarter is generally good as people are literally gearing up for golf season. This is the springtime. You got people who know that they got the warm weather all summer through the fall, so they're buying their golf equipment usually in the springtime, and that's exactly when Q2 was. So this is good news, but it's also should be kind of expected. Let's dive right into just some of the other highlights that they said in that conference call for MODG or Topgolf Callaway. And I want to highlight this point here. You could see that they're delivered now 7 consecutive quarters of positive same venue sales growth. And this is super important for Topgolf because this means not only are they making more Topgolf locations and getting more revenue because they've now expanded their footprint, but no, they're actually getting people to come back. And this is something that's very important for any business, that people enjoy their experience experience at Topgolf so much that they might even tell friends. They might even come back again themselves. So this is super important and something you want to see as an investor, that people are grasping something fun to go to, an experience worth spending money at. You can see some other highlights there, but that was the big one that I wanted to highlight. But always important to look at the risks of any company before you invest. And full disclosure, I do own a little bit of MODG, Topgolf, Callaway brands myself. But it's important to be honest with yourself and look at these risks. Golf equipment and lifestyle segments, they're flat. They're slightly declining even. This is not growth sectors. It's really Topgolf here that's driving that brand and this stock's net income and revenue growth, because those other sectors, as you saw, the interest in golf is somewhat plateauing. If on-course sales are plateauing, you might go to a driving range and you might use one of their drivers or their putters or whatever, but you're not going to actually be going to get a driver after you go to a driving range all the time. And also it's funny because the future of golf is pretty uncertain right now. If you've been following what's going on with the Live Golf Tour and the PGA Tour merger, people are just kind of somewhat hesitant to really buy into the future of what professional golf looks like. And though Callaway has a big deal with Jon Rahm, which is one of the best golfers in the world right now, it's still not sure how people are going to respond, whether they're going to go to other activities, whether they're going to, this isn't a huge deal for maybe something like Callaway because they don't get a lot of their revenue from probably the advertising on Jon Rahm's shirt or whatever, or his hats. But it is important to also just note that people might choose different things if this Live Golf PGA merger doesn't work out. They might choose different hobbies or activities to follow. And there's a compounding effect. You watch something, so you want to go do something. You go to a driving range, so you want to go buy a new driver. You want to, you got a new driver, so you got to go to the driving. It's a back and forth type of thing. And it's good when golf is good. The business is good when people's interest in golf is high. And another risk here to identify is that building a new Topgolf facility is super expensive to do. We're talking tens of millions of dollars. It's a very debt-heavy process, and depending on how expensive the land is, it could be even more than that. They increased their net debt from $1.44 million to $2.24 million over the past year. And you know what? I actually think that that's a mistake. I think that should be $1 billion right there. That those M's should be B's. But they're doing it because they're seeing return on these facilities. These are not facilities that are just totally flopping. Most to all Topgolf facilities are paying back within 2.5 years of their initial investment, but they are very debt heavy. They're opening 11 new venues in 2023. They claim to stay on pace for opening 11 new facilities. So imagine how much more debt they've had to take out for doing such. And it's important that they claim they're going to stay cash flow positive for 2023. This is a risk to me because this is just a claim at this point. We can't say for certain they're going to stay cash flow positive, especially if you're telling me you're opening 11 new venues this year. That's a lot of capital intensive new projects that you're starting in a potential recession scenario. So this is something in a high interest rate environment you want to be very aware of. The last thing I said, it does take about 2.5 years to make back that initial investment. So it's not like they're going to be making money on these 11 new venues until 2025 or later. So note that as well. Let's get into the valuation here of Topgolf, Callaway brands. And you can see I take a sum of the parts approach to this valuation. There's three main sectors: Topgolf, golf equipment, and active lifestyle, which includes those apparel and other brands that they own. Sales, and you could see Topgolf, they're the ones that revenue is increasing 16.6%, and the others are slightly down, not quite a full percent. So let's just call it slightly down to about flat. They've got those three sectors. The Topgolf's growing, slowing apparel, slowing equipment. Plus, they did say last year in May 2022 that they're buying back or authorized to buy back $100 million dollars worth of shares. And this is good. You want to see this as an investor, especially when you think that the share price is slightly lower than maybe it could be. It's slightly suppressed right now, you would say, compared to where you think it could be in the future. It's a good time to buy shares rather than potentially using that money later to buy back shares when the shares may be regularly valued or even overvalued. So I do want to take a look at the apparel section of the business first. So you got some comps would be like Nike or Adidas. These are companies that maybe have a little bit more name recognition than Callaway, or certainly do, especially Nike. So the Callaway brand maybe isn't worth the premium that you'll see on a brand like Nike at that 3.36 price to sales, and that's looking at revenues. Same with even Adidas. It's 1.42. That name maybe isn't quite as big, but still has a lot of name recognition. So I say Topgolf Callaway at a price to sales of just a measly 0.89, which is under 1, is probably appropriate for Callaway Topgolf. They're not shrinking very fast. They're roughly staying flat, so we're not going to say that they're totally a dying business, but a 0.89 is probably appropriate for those sectors. It's definitely not appropriate, however, for the Topgolf sector. And that's why I have that little conclusion there that only 60% of the business is fairly valued, and that's the revenues made up by golf equipment and active lifestyle. I don't agree that the Topgolf sector should be at a price to sales ratio of 0.89 when it's growing 16.6%. Yes, it's currently 40% of the business by revenue, but I totally think that that's going to flip over the coming years, and that's going to become like 60, 70% of the business because of how fast Topgolf is growing. How I look at this, how do I value the Topgolf sector of the business? They did $874.3 million in the first half of 2023. So that was only at 80 locations worldwide. About 71 of those locations, I think, were in the U.S. Topgolf forward guidance for the full year is $1.9 billion of revenue for just Topgolf. So you're telling me, I think this number is going to obviously increase over the coming years if they're opening 10 locations per year for the next 5 years or so. And they actually plan to do a lot more than that. But I think that that's pretty conservative for going into a potential recession type scenario, which 2024 and 2025 could be down years for the economy. It's always important to, plan for the worst. And between new locations and the same venue coming back, sales, like I highlighted, that 7 consecutive quarters of people coming back and spending more money, we're going to assume a measly 12% growth per year in revenues in just Topgolf. And honestly, I think this number is going to be much more like 20s, maybe even 30% per year revenue growth because of the new locations and people coming back. So even at a very conservative 12% growth a year, you're talking in 2028, just Topgolf would be making $3.348 billion every year. And even next year, they'd be making $2.128 billion in just Topgolf. And this is why I don't think this 40% of the business should be valued at a price to sales of less than 1. No, let's look at the price to sales of some other entertainment company like a Six Flags. They got a 1.43, and Six Flags is not growing nearly as fast as Topgolf. In fact, people are not going to Six Flags as much as they're going to Topgolf. So why would their multiple be higher? Something maybe a little different would be IMAX. They're an entertainment company, a little bit more like a sit down, not necessarily like a theme park like Six Flags. It's hard to find a perfect comp for this, but price to sales for IMAX is over 3. And so to maybe justify a price to sales of about 2 for Topgolf, maybe right down the middle on those, even a little closer to the Six Flags side. So even at a more conservative price to sales of 2 for just the Topgolf, remind you, and the other segments, you're assuming flat to decline in golf equipment apparel. They still make about $2.9 billion per year, and we'll assume that's even if they do shrink a little bit. We'll put them even lower their price to sales at 0.5. Give them, that segment, a market cap of $1.45 billion. So that's just for the other segments. Topgolf alone, at a 2 price to sales, gives you a valuation for just that segment of $4.256 billion for next year, and you add that to the other segment, you could get a total value in 2024 of $5.71 billion, or an upside of over 81%. And that 12% CAGR, that compound annual growth rate, at 2028 numbers would put you at $6.69 billion in 2028 for the market cap of just Topgolf. And remember, add that to that other segment's market cap, because this is a sum of the parts analysis, and you're looking at, in 2028, this stock could be worth $8.15 billion in market cap, and that's way higher. That's $5 billion higher in market cap than their $3.15 billion valuation today as of August 2023. And that could be a growth of over 150%, 158%. And that would be roughly $27 a share. And this could be even higher if they do continue to buy back their own shares at cheap prices, because they're putting their money to work so that there's less shares out on the market. And that makes everyone else's piece of the pie worth a little bit more. So do I think that this is perfect math? No, but this should tell you that even in next year's numbers, if this was valued at a, Topgolf was valued at a 2 price to sales, you're looking at a much higher valuation. And that's I think, fair. I think that's even a little bit conservative. And maybe it'll take some years for it to grow into that valuation, but should it grow into that valuation by 2028, you're looking at a stock that should certainly more than double from here. But I think this one is a really good opportunity, especially if you want to diversify maybe away. You got a lot of tech in your portfolio, or you got a lot of energy. I think this is a fun one. This is a business that you could really easily understand, and it's different than a lot of other businesses, especially in my portfolio. So that's why I've diversified into it. I hope you appreciate this video. Thanks for watching. I am not a financial advisor. Extremely important to know that this is for entertainment, and it's not because I think that you should go out and buy this stock today. You do your own research, but also like our videos. Feel free to comment down below. Tell us what other stocks you're looking at and you want me to do an evaluation of, and share this video with your friends. Subscribe, hit that bell. Thanks. Once again, this is Nothing But Net Income signing out.